Happy close of market on Tuesday, 4th of February. This is Stock of the Week number 3, Orbital Corp Limited, or OEC. We got here a stock that pumped up 35.7% today, opened up at 49.5, a high of 69, and closed at 66.5 today. Unfortunately, I did miss this one in the morning. I had other things to do. However, at quarter to 12, I did manage to pull out a tweet that OEC did hit a nice resistance and was looking good technically. It hit here at 63 and pulled back down to 61. And as that happened, let's have a look here on the 5-minute chart. It failed to pull back down. It tried to break through again that resistance level, but failed. And we hit a 38.2 support level. Now 38.2 is perfect for a stock like this, and I'll go through exactly why on the fundamentals. But if we had a stock that was flimsy, was speculative, let's say a real common one that's been going around is a small microcap company will sign up with a big giant corporation like an Intel, a Microsoft, a Tesla, a BHP, or something like that. And they'll say that, hey, we've got an agreement and we've signed off on it. But they won't release any financial information, any benefits, any profits, revenues, nothing. They'll just say we've got an agreement with this big ass company. And that right there is a speculative, terrible announcement. And guaranteed, if this stock had a terrible speculative announcement like that, it'd hit at the bare minimum 50% or hit 61.8%. However, the numbers were shown, the revenue was shown, the profits were shown. There was a little bit of speculation there, but it was pretty significant. The financial figures were very significant. So 38.2 was a perfect target. Now, me personally, I didn't manage to get 38.2. I did hit at 57, and I think it was 58 or 58.5. I did buy on market, so I might have paid a little bit, just that little bit extra. But let's go through the fundamentals. So the first time this stock really had any volumes and movement was on the 29th of January. And since then, it's been growing quite exponentially in volumes and share price movement. So let's have a look at what the announcement was on the 29th of January. This document is basically just outlining that they're doing well. They're doing what they said they would do. Ultimately, the only thing that really matters in this entire announcement, if you're a new shareholder, is this part here. The company is maintaining revenue guidance of 25 mil to 35 mil for the financial year 2020. Let's have a look at why that might actually be significant. The first thing we want to look at is the number of shares on the market. So the Appendix 3B document on Section 8, it has 77.5 million shares. We multiply that by the share price, which at the time of 29th of January was 37.5 cents, gave us a market cap of $28.7 million. Now, what makes this very interesting is we have a stock that's claiming to have 25 to 35 million revenue target for the year, and they're trading at $28 million. They're trading at 1x revenue, 1x yearly revenue, which is super unusual. Because if we were to put a broad stroke on a generalized view of valuing a business, you'd say anywhere from 2.5 to 3x is roughly what you'd value a business. If you walk down past a local cake shop and they pulled in 1 million revenue, they'd probably sell their business anywhere from $2.5 to $3 million. It's a very similar thing on the ASX. Of course, this sector matters. So depending on what sector you are, there's different multiples that you'd value it at. And of course, profitability also matters. But the point, the key driving factor here is that these guys are trading at 1 times revenue, which is super unusual. So what we have here is the Appendix 4E, which is the annual report for 2019. I don't know why these guys don't have an Appendix 4C, which is the quarterly financial statements. I don't know how they get away without producing one. Some companies on the ASX manage to. I don't know how, but let's go through this anyway. So in 2018, they had 13 million revenues. We've now got 22 million on the stock. So they've almost doubled in revenues in 1 year. They've slightly reduced their cash payments to suppliers and employees. So they're now a cash positive business. They've gone from running at negative $8.7 million for the year to now being positive $1.7 million. So if we look down here into cash flows and investing activities, it's important to note that these seem like optional things to grow the business. So when we spend $5 million here, that's not necessarily a bad thing, because when we take away 5.2 million from this 1.78 million, we'll obviously end up with a debt of around $4 million for the year. But that's not a terrible thing. Debt is not an awful thing, because we're in cash flow positive territory for the business. But these guys are now purchasing plant and equipment materials and they're buying other intangible assets. Now, I don't know what these are exactly, but typically this is where you spend money to grow your business. This is the equivalent, or almost the equivalent of R&D. This is optional. These guys could probably get away with not spending anything and just sitting on $1.7 million profit, but that is not a healthy position to grow a business. So guys, when you see a debt of roughly $4 million for this business in 2019, that is not a terrible position to be in. We are cash flow positive of 1.7. We are spending 5.2. That is an optional spend. This is not because it's a loss-making business. I really want to outline that fact because some people look at the overall financials as negative when in fact it is healthy and positive. And finally, we're looking at the cash and cash equivalents. Last year, they had 17 million in the bank, and after all the spending, they ended up with 9.9. And of course, that flows on to 2019. So they had 9.9 mil to spend, and they end up with a total position of negative 3.6. And whatever this is, fluctuations of exchange rate, I don't really pay too much attention to that because the only number that matters here really is this number here. They have $7.5 million in the bank. They are a $28 million business at 29th of January. So this is a really healthy position to be in. Let's go through the only other document that's been released since the 29th of January, and that is the investor presentation of 2020. So if we open it up, we scroll down and we see right off the bat, there's an interesting little note here. There's a contract with Boeing, or one of Boeing's smaller companies, to supply up to $350 million of military drone engines. Now, if we consider that over 5 years, so if we scroll down, so the information here is just really what is a tactical UAV. You don't need to read that. You don't need to read the UAV defense market because this doesn't really matter. This is just the overall view of the market. So there's a bunch of companies involved in that. This is not specific to this company. So if we scroll down, this is the important part, existing clients. So In Situ is a Boeing company that was referred to earlier, $350 million over 5 years, which is essentially guaranteed revenue for the next 5 years, or in this case, the next 3 years. And then we've got existing systems with Textron. However, this is the one that's really interesting. Let's keep scrolling down. This is just general information about the stock and what they produce. We get down to the second last slide here, and this is what we're really interested in, the financials. We've got a stock here that has revenue guidance for the year of $25 to $35 million. Now, we don't have profit targets, but we can make safe assumptions based on the financials that we just covered that the business increases its revenues while maintaining the exact same expenditure. Actually, they've decreased it over the years. So they've gone from 22 million down to 21 million spending in order to produce their product. So if we hit 25 million and 35 mil, so let's say we got 25 and we keep our spending at 21, this company will be sitting at $14 million profit, which is double last year's profit, which was $7 million. Now, if we have a company here that's at $14 million profit, assuming this guidance is fair and accurate, and so far we have no reason to suspect this to be a false guidance or a false revenue target. These guys have proven their financial acumen, their ability to deliver. So we have a reasonable target of $14 million profit. Now, 14 million profit into a stock that was valued not too long ago at just under $30 million. That's incredible. We've got a company valued 2x its profit, not its revenues, its profit. That's insane. Plus, it's got cash in the bank, sitting at, if I recall correctly, it was sitting at $7 million cash in the bank. So we have a business that's going to be $14 million with $7 million in the bank. Sorry, so that's 7 plus 14. We're going to have a company that's roughly got $21 million in assets and profit, and it'll be trading at roughly $30 million market cap. And that is insane, absolutely insane in terms of profitability and market value. And I know what you're thinking, right? The market cap is no longer 28 million. It's no longer January 29th. We're sitting on February 4th, closing price of 66.5, which gives us a market cap of $51.5 million. Some of you may also look at the chart here and look at it and go, it's too parabolic. I don't want to be caught at the top. Because a lot of us, particularly newer traders, are stuck with this mentality of buy low, sell high, something that's been perpetuated for decades. It sounds like common sense, but guess what? You're just not going to make money buying low and selling high. You're going to make money by buying high and selling higher, which is what I've done. I bought here just under 60 cents. I bought near the highs, and I intend on selling it as it goes higher. To me, it's common sense. It took me many years to break out of that mentality as well of buy low, sell high. So if you're still not convinced, let's have a look at the financials here. We got 51 million market cap. We've got a stock that's targeting 14 million profit with 7 million cash in the bank, gives us $21 million. We're targeting revenues of $35 million for the year at 3x. At 3x of 35 gives us 105 million market cap. If we just give that generalized rule of thumb of 3 times revenue, we'd be sitting at 105 million market cap, which is about $1.35 on the charts. Unfortunately, $1.35 seems a little bit out of reach. Perhaps in the midterm or maybe in a month or two it could get there. I think this target here, a horizontal target here of 96.5 is reasonable. If we sell around here, that would give us a market cap of just under $75 million. That gives us 2 times revenue. 2 times revenue for hitting 96 cents. Now, I'm not giving guarantees to anyone that this will hit 96 cents. This is simply me talking out loud based on my fundamental research. This is me talking out loud about my technical analysis. I've made a sound decision to enter just below 60 cents, even though I was a bit late to the party. I've now got a reasonable and sound exit target of around 95 to 96 cents based on the technicals and based on the financials. I've got 2 times revenue as my target for the market cap, which is roughly 70 to 75 million, which happens to line up with this horizontal target here, the technical analysis of 96.5 cents. Now, will it get there tomorrow? I don't know. Will it gap up and hit this horizontal here at 84 cents and pull back down and push up for the rest of the week? I don't know. Will it gap down and open at 63 cents and push upwards? Will it tank down to the downside? I don't know. I don't know what the market thinks. I just simply have my analysis, and whether you believe it or not, whether you buy into this story that I'm selling is entirely up to you. But I've put forward my case, and I'd be interested in what you think. So please do leave comments below and give this video a thumbs up if you agree, and if you think I'm full of shit, thumbs down, and please do subscribe. It makes a big difference to the channel. Thanks, guys.